Hey guys, so when your assets goes down in value by 20%, these are among the scariest market events you will ever encounter. But long-term investors can stay the course. The words bear market strike fear into the hearts of many investors, but these deep market downturns are unavoidable and often relatively short, especially compared with the duration of bull markets, when the market is rising in value. What's more, in that bear markets can even provide good investment opportunities. But before this video, guys, please like this video and subscribe to my channel, as it keeps me motivated to create these videos for you guys. Now, what is a bear market? A bear market happens when a market experiences prolonged price declines. It typically describes a condition in which securities prices fall 20% or more from recent highs amid widespread pessimism and negative investor sentiment. Bear markets are often associated with declines in an overall market or index like the S&P 500. Bear markets also may accompany general economic downturns such as a recession. But differently from simple bear market, a recession is considered when we see two consecutive quarters of negative gross domestic product (GDP) growth. While 20% is the threshold, bear markets often plummet much deeper than 20% over a sustained period. Although a bear market may have a few occasional relief rallies, the general trend is downward. Bear markets are characterized by investors' pessimism and low confidence in the market. During a bear market, investors often seem to ignore any good news and continue selling quickly, pushing prices even lower. Eventually, investors begin to find stocks attractively priced and start buying, officially ending the bear market. There can be bear markets for a market as a whole, such as S&P 500, as well as for individual stocks. When investors are bearish on an individual stock, that sentiment is unlikely to affect the market as a whole. But when a market or index turns bearish, almost all stocks within it begin to decline, even if individually they are reporting good news and growing earnings. A bear market often occurs just before or after the economy moves into a recession, but not always. Investors carefully watch key economic signals, hiring, wage growth, inflation or CPI index, and Fed funds rate or interest rates to judge when the economy is slowing. When they see a shrinking economy, investors expect corporate profits to decline in the near future, so they sell stocks, pushing the market lower. A bear market can signal more unemployment and tougher economic times ahead. Bear markets tend to be shorter than bull markets, 363 days on average versus 1,742 days for bull markets. They also tend to be less statistically severe, with average losses of 33% compared with bull market average gains of 159%. Now, here are a few tips on how to invest during a bear market. The first one is to use dollar cost averaging strategy. Say the price of a stock in your portfolio goes down by 25%, from $100 a share to $75 a share. If you have money to invest and want to buy more of this stock, it can be tempting to try to buy when you think the stock's price reached its bottom. Problem is, you will likely be wrong. That stock may not have bottomed on $75 a share, rather, it could tumble 50% or more from its high. This is why trying to pick the bottom or time the market is a bad strategy. A better approach is to regularly invest money to the market with a strategy known as dollar cost averaging. Dollar cost averaging is when you continually invest money over time and in roughly equal amounts. This helps smooth out your purchase price over time, ensuring you don't pour all of your money into a stock at its high, while still taking advantage of market dips. There is no doubt that bear markets can be scary, but the stock market has proven it will bounce back eventually. Of course, if you are not investing in individual stocks, but market index as S&P 500. The second tip is to diversify your holdings. Speaking of picking up stocks at lower prices, Boosting your portfolio's diversification so it includes a mix of different assets is another valuable strategy, bear market or not. During bear markets, all the companies in the given stock index, such as the S&P 500, generally fall, but not necessarily by similar amounts. That's why a well-diversified portfolio is key. If you're invested in a mix of relative winners and losers, it helps to minimize your portfolio's overall losses. If only you could know the winners and losers in advance, because bear markets typically precede or coincide with economic recessions, investors often favor assets during these times that deliver a steadier return, irrespective of what's happening in the economy. This defensive strategy might mean adding the following assets to your portfolio, like dividend-paying stocks. Even if stock prices aren't going up, many investors still want to get paid in the form of dividends. That's why companies that pay higher than average dividends will be appealing to investors during bear markets. And the second one is bonds. Bonds also are an attractive investment during shaky periods in the stock market because their prices often move in the opposite direction of stock prices. Bonds are an essential component of any portfolio, but adding additional high-quality, short-term bonds to your portfolio may help ease the pain of a bear market, as bonds provide steady and guaranteed returns. The third tip is to invest in sectors that perform well in recession. What investments do well in the bear market? Think about the things consumers will need no matter what. Those are the sectors that tend to perform well during market downturns. Even amid high inflation, people still need gas, groceries, and healthcare, so things such as consumer staples and utilities usually weather bear markets better than others. You can invest in specific sectors through index funds or exchange-traded funds, which track a market benchmark. For example, investing in a consumer staples ETF will give you exposure to companies in that industry, which tends to be more stable during recessions. However, you should be aware that such ETFs do not perform as good as a whole market index as S&P 500 in the long term. The fourth tip is to focus on the long term. While bear market periods are difficult to endure, history shows you probably won't have to wait too long for the market to recover. And if you are investing for a long-term goal, such as a retirement, the bear markets you will endure will be overshadowed by bull markets. So money you need for short-term goals, generally those you hope to achieve in less than 5 years, should not be invested in the stock market in the first place. Still, resisting the temptation to sell investments when markets plummet is difficult, but it's one of the best things you can do for your portfolio. Ultimately, bear markets are a good time to revisit your goals and objectives and remind yourself of why you're invested where you are. If your asset allocation feels right, stay the course. If it feels off, a bear market could be an opportunity to readjust your accounts while paying less in capital gains than you would during a bull market. It can be scary to see stock prices fall 20% or more from a recent high, but the worst thing an investor can do is panic. The average bear market lasts less than a year, and investors can mitigate the effects through simple techniques such as dollar cost averaging, diversification, investing in relatively recession-resistant sectors, and focusing on the long term. Well, I hope this video was helpful for you guys. Guys, do you invest during bear market? Leave your comments down below. So guys, if you like this video, please press thumbs up and subscribe to my channel, as it keeps me motivated to create these videos for you guys. Thank you for watching and see you in the next video.